Hi, I'm Jeff Lovell, a staff accountant with AA Accounting, and today I want to talk about the basics of inventory. On a typical P&L or income statement, gross sales, excluding sales tax, are listed first, from which we deduct returns, refunds, sales discounts, and allowances to arrive at net sales. From net sales, we deduct cost of goods sold to arrive at gross profit. From gross profit, we deduct our operating expenses in order to arrive at net income or loss. Typically, cost of goods sold is a high percentage of net sales, perhaps even over 50%. For this reason, it can be one of the most important numbers to get right on the tax return. Two typical methods for calculating cost of goods sold are the tax return method and the direct method. Under the tax return method, we start with beginning inventory and then add to it any purchases of inventory and other capitalized costs to arrive at goods available for sale, from which we deduct our ending inventory to arrive at cost of goods sold. The direct method simply takes the purchases and other costs, totals them up, and then adds or subtracts whatever the change in inventory was in order to arrive at cost of goods sold. The change in inventory is your beginning minus your ending inventory. Both methods will arrive at the same cost of goods sold figure. In order to know your beginning or ending inventory numbers, you need to separate supplies from inventory. In a typical business, the inventory are products either produced or purchased by the business for resale that make up a high percentage of the business's sales. For example, bottles of liquor would be inventory to a bar, whereas cleaning supplies would not be. In a grocery store, by contrast, both the liquor and the cleaning supplies might be classified as inventory. The benefits of keeping track of inventory are that it reduces shrink and manages your costs and helps you to make better purchasing decisions. Also, the IRS requires you to keep a physical inventory if your average annual receipts are over $10 million, or if you started keeping an inventory at the beginning. You have to continue to keep inventory in order to use a consistent method. If your business keeps inventory in order to calculate cost of goods sold, the IRS requires that you take a physical inventory count at least annually. A typical example of an inventory count sheet is displayed on the screen. Each row is a separate inventory item, across from which is its part number or UPC, the unit cost assigned to the product, and the count on hand. The unit cost times the quantity gives you the total value for that item. The sum of all the values equals the inventory on hand. The unit cost is determined by your inventory costing method. Typical examples are first in, first out, last in, first out, average cost, and specific identification method. Choosing a proper inventory costing method is very important and has a direct impact on your taxable income. However, this is outside the scope of our conversation today. Give us a call at AA Accounting if you're interested in exploring this topic in more detail. At AA Accounting, we have over 60 years of experience helping self-employed entrepreneurs grow their businesses. We're here year-round to assist you. Call us today to set up an appointment with one of our tax and bookkeeping experts. We look forward to hearing from you.